FHA just made a huge change in the way it calculates income that should allow you to qualify for more home. And in today's video, we're going to talk about that change in addition to talking about income in general. A lot of home buyers have questions about how their income is calculated, as well as employment, what documents are needed. So in today's video, we're going to dive into that in a little bit more detail, help you understand income when it comes to FHA loans, so that not only you can do some calculations on your side to see if you qualify, but to also give you a better idea if FHA is the right loan for you. Now, I typically like to start these videos by acting as if you know nothing about FHA loans, just to give you a brief overview of why people choose FHA. A lot of people believe FHA loans are only for first-time home buyers, and that's simply not true. Anybody can use an FHA loan. In fact, you can use it more than one time. So why do people consider it a first-time home buyer loan? Well, it's typically because they allow a minimal down payment when it comes to buying a home. In fact, you can put as little as 3.5% down when buying a home, as long as you have a 580 or better credit score. In fact, you can go down as low as a 500 credit score with FHA if you have up to 10% to put down. Now, one of the key differences in putting a little bit more money down is that when you put 10% or more down, the FHA mortgage insurance, the monthly mortgage insurance that you pay, is going to fall off after year 11. Whereas if you put any less than 10% down and you buy using an FHA loan, you're going to have mortgage insurance on that loan for the life of the loan, regardless of how much equity you have in that property. Now, you can refinance in the future into a conventional loan, assuming you qualify and remove that mortgage insurance, but as long as you have that FHA loan, you're going to have mortgage insurance on that loan. And one other thing to understand when it comes to credit scores and down payments is just because you have a 580 credit score, for example, and you have 3.5% to put down, that doesn't necessarily mean FHA is going to approve you. In fact, it doesn't mean that the lender that you go to actually does FHA loans with that low of a credit score. And that's because some lenders have overlays on their guidelines. Even though FHA, which is essentially the federal government, allows homeowners to put as little as 3.5% down with a 580 credit score, lenders out there that do these loans, because the government doesn't do these loans, they just back them. You have to go to your local bank or a mortgage broker to actually get an FHA loan. And some of these lenders just simply don't do these loans because they have overlays on their program. They're looking for a more high quality buyer when it comes to credit scores. So just keep in mind, just because you meet some of the basic requirements doesn't necessarily mean you're going to be approved for an FHA loan. And another thing on that topic, I'm going to be doing some basic calculations in this video as well. Now, I don't want you to take them and run with them and calculate your income and just assume based on those calculations that you're going to qualify for the loan. In fact, I recommend that you speak to a mortgage professional to see if you actually qualify for an FHA loan. Have them look at your credit, have them look at your income, and determine whether or not FHA is the right loan for you. Now, if you're watching this video and you don't know where to start, I put a referral link in the description of this video to connect you with somebody I know, like, and trust that can guide you through that process. So if you're new to the pre-approval process and want to see where you stand, do me a favor and check that out. Now, when it comes to buying a house and using FHA, one of the questions that comes up, is there a minimal amount of income that I need to make? And the answer is no. There's no minimum amount of income. In fact, there's no maximum amount of income either. You just have to qualify based on the FHA guidelines. And one thing about FHA that's really, really nice is that FHA probably has the most flexible guidelines when it comes to qualifying a buyer to buy a home. And that's because they allow you to have more monthly debt towards your income than any other loan program out there. And that's because they allow up to 57% on the back end of your debt to income ratio, which means they take your total mortgage payment, the principal and interest, the taxes, the insurance, if there's an HOA, any of the expenses to buy your house, and then they take any of your other monthly expenses that show up on your credit report, and they divide that into your income, and that number can't be more than 57%, which is a calculation we're going to do in just a little bit. But I want to start by talking about types of income that FHA uses in order to qualify you to buy a home, and one of the recent changes that they've made that could allow you to qualify for more homes. So when people think of income, they typically think of a W-2 employee, somebody that receives a salary or somebody that is paid hourly, where your taxes are taken off in each check. Well, FHA definitely uses that type of income. In addition to that, they allow overtime, they allow bonuses, as well as commissions. But here's the key when it comes to those three things. You actually need a 2-year history of receiving them in order for the lender to use that income towards your qualifying income, which means if you just got a job and you're receiving a salary and you've done some overtime and it shows up on your pay stub, well, the lender can use it as long as you have a history of overtime, bonuses, commission, that sort of thing over a 2-year period of time. Now, it doesn't have to be with that employer per se, so you could have a history of it from a previous employer, but it can't be something new. Like this is your first job and now you've got a little bit of overtime. Well, the lender's typically not going to allow you to use that because you don't have a history of receiving it over an extended period of time. On top of that, they'll also allow you to use part-time jobs or multiple jobs, but it's the same scenario in that instance where you have to have a history of doing it. So if you've had 2 jobs or multiple jobs for at least a 2-year period of time, then chances are the lender is going to allow you to use both of those incomes toward qualifying for that home. And another type of income that they will allow is alimony and child support, as long as you have documentation that that is going to continue for the foreseeable future. On top of that, they also allow retirement, Social Security, as well as disability income in some instances in order to help you qualify, along with rental and other passive income. But here is where the change has been made with regards to FHA and some of the income qualifications that they're allowing. FHA will now allow you to use rental income from an ADU, an accessory dwelling unit that you have on your property. So prior to within the last couple of days, FHA would not allow you to use income from one of these properties that you have on your property in order to qualify for a loan. Now you might be watching this video going, Jeb, I have no idea what an ADU is. Well, FHA actually defines an ADU as a single habitable living unit, which means that it has a separate ingress and egress from the primary home on the property. Now, if you're not sure what ingress and egress is, that's basically a door, some way to get in and out of the property outside of your primary home. Now, in some cases, this can be added to or created within or even separate from your primary home. So it doesn't necessarily have to mean that it's a separate unit on the property. In some cases, it can be a garage conversion, but it just has to comply with city codes. And the big change that they made is that they'll now allow you to use 75% of the rental income of that unit in order to help you qualify to buy that home. And on top of that, if you're doing a 203K, like a rehab loan with FHA, which allows you to do the improvements through the loan, if you're planning on building an ADU and that's part of the plan, they'll actually allow you to use 50% of the proposed rents from that property in order to help you qualify as well. So there's some big changes here that can help you qualify for more home when using an FHA loan. Now, here's what I'll say about this whole thing. This is all very, very new to FHA guidelines. It's a recent change. So if you're out there talking to somebody and they don't know what we're talking about, that's probably because they're not keeping up to date on the guidelines. This is very, very new. But here's the thing. If you want to speak to a professional, somebody that knows what they're talking about, there's a referral link, as I mentioned below, with somebody that will actually know this law and can guide you through that process of helping you understand it. Now, before we dive into how FHA actually calculates your income, I want to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. Now, when it comes to how FHA calculates your income, it can be a simple calculation or it can be a complex calculation depending on the type of income that you receive. Earlier in the video, we talked about the different types of income that you have. If you're just a salaried employee or just a W-2 employee, then it's a pretty simple calculation. What you do is you take your gross monthly income before any taxes are taken out. Let's just say for this video, that's $75,000 a year before any taxes are taken out. Well, you take that and you divide it by 12. That gives you $6,250 per month. That is the gross monthly income that FHA will use when it comes to calculating your debt to income ratio. Now, if you're a 1099 employee or you're self-employed and you have deductions and you have different things going on, the calculation is a lot more complex and you definitely need a professional to do that calculation. It's really, really tough to explain how to do that in a video. So just make sure if your income is coming from multiple sources or you don't pay taxes in your pay stub every month and you have different write-offs, make sure you're talking to a professional and going through that process and not trying to do the calculation on your own. That way you know exactly exactly how much home you can afford to purchase versus relying on your own numbers. Now, one thing I want to be clear on when it comes to income calculation is typically you need 2 years in the same line of work. So if you've been a server for 2 years, you typically need to be on that job for 2 years. Now, you can be at multiple restaurants. You can be sometimes, maybe a hostess or in management or doing different things. But as long as you're in the restaurant business, it's the same kind of work. But typically what most lenders don't want to see is that you go from, say, being a wage earner, somebody that is paid a salary or paid hourly, and then become a commissioned employee without having a 2-year history of it. Because in that case, most lenders are going to have a problem with that change in the type of work you're doing. Now, if you're going within the same line of work, sometimes it can be less hairy, but again, it's one of those reasons that you want to be working with a professional when doing these calculations, just to make sure somebody is looking at your income and calculating it properly. Now, earlier in the video, in our example, we used $6,250 per month as our qualifying income. That's because we were using $75,000 per year as our gross monthly income. Well, in the case that, say, we had a $2,500 mortgage payment, just principal and interest, taxes, insurance, everything that's included with that property, not utilities, not gas bills, not anything like that, no cable bills, just, the primary expenses of that property. And let's say the mortgage payment on that is $2,500 with all of that stuff included. Well, what we do is we take that monthly mortgage payment, which is essentially your front end ratio, so that's $2,500, and then we add any other monthly expenses that you might have. Say you have a car loan or a credit card or student loans, that sort of thing. And we add those to the $2,500, and then we divide it by 6,250. That will give us our back end ratio and determine whether or not you could actually afford a mortgage payment of $2,500 in this case. So let's just say that you had a $2,500 mortgage payment and you had no other monthly debt. Well, you would take that $2,500, divide it by 6,250. That gives you 40%. So that's your back end ratio. So in that case, you should qualify for an FHA loan, assuming you meet all the other requirements. But let's use another example. Let's say you have that $2,500 mortgage payment that you're trying to qualify for, and you have a $500 car payment, and let's say you have $500 in credit card bills that you pay every month. So that's $3,500 in total. Well, what you do is you take that and you divide it by the 6,250, which is your qualifying income that we talked about earlier. Well, that gives you a 56% back end ratio. So in this case, you meet the back end ratio requirement. So in that case, you should also qualify because your front end ratio, the $2,500 mortgage payment divided into the 6,250 gives you 40%. So that was your front end ratio. So you've met the requirement there because the max front end ratio is 47%. And then the max back end ratio was 57%. So in this case, you were 56%. So in theory, you could still qualify, assuming you meet all the other guidelines. Now, if this is confusing, I completely understand. And that's more the reason that I keep talking about talking to a professional. It's super important when you're going through the process that you're working with somebody that knows what they're doing. Don't call the kid in the call center. Call somebody that is experienced, that's been doing this for an extended period of time, somebody that can answer your questions and guide you through the process. Because honestly, the last thing you want to do is have somebody tell you that you're approved, get under contract, and then find out that you actually aren't in a position to buy a home because somebody didn't do a correct calculation. Now, when it comes to documents that you'll need to see if you actually qualify to buy a home, typically what a lender is going to want to see is the last 2 years of your W-2s. If you're a salaried employee or an hourly employee. Now, if you're self-employed, they're going to want to see the last 2 years of your tax returns on top of asset account statements. So they're going to want to see the last 2 months of your checking, your savings accounts, just to see how much money you have. They're also going to want to see your last 2 pay stubs if you're a salaried employee. If you're self-employed, they're going to want to see a recent profit and loss. On top of that, they're going to run your credit, and they're going to take a look at your credit, and they're going to do the calculations that we just talked about in order to determine exactly where you stand. Now, I want to say something that's really, really important. If you're going through the pre-approval process and you're just talking to someone on the phone and you're not providing any of these documents and they're coming back and they're telling you that you're approved without looking at your tax returns, without looking at your pay stubs, your W-2s, without running your credit, then unfortunately, you haven't been pre-approved at all. You've been pre-qualified, which means that you're not really in a position to go out shopping for homes. You really need to be pre-approved. You need to provide this documentation. You need to have your credit run so that you know exactly where you stand. Now, this should be a free process. There shouldn't be any fees to do this. It should be free wherever you go to have that conversation. And the last thing I want to say when it comes to FHA is when you're going through this pre-approval process, have your lender show you other loans as well. Give you a side-by-side comparison of a conventional loan if you qualify qualify for a USDA loan if you're in a rural area, and put all the loan programs side by side so that you can make the decision for yourself which loan program is right for you, so that you don't feel like you're getting pushed into FHA or pushed into conventional or whatever. Have all the loans side by side and you make the decision for yourself. But if you're watching this and you want to know all the qualifications when it comes to FHA loans, all the nitty gritty, if you will, do me a favor and check out this video here.